What's up? What's up? What's up? Welcome back to my channel. It's me, the Millennial Investor 1914. Holla at your boy. I finally got some time to myself. I started a new job last month. And so as you know, when you start a new job, it's the formalities, getting to know the job, rules, regulations, understand expectations. But now I got that 1 month underneath my belt. And so I can now begin to come back to making more of my videos. Hopefully you guys miss me. Remember, my portfolio, my goals was basically roll to 100,000 in my dividend growth portfolio. Definitely want to go through many changes that I decided to make with my dividend growth portfolio, but also my other portfolios as well. And by me being with a new company, new 401k. And unlike my other companies, this company has uh, Vanguard. So that should be interesting. I never had a company that invests into Vanguard. But what you have noticed is, if you definitely haven't noticed, is Trump, tariffs, uncertainty in the market, the Fed, Powell, everything really to make your portfolios to go down more than 10%, 50%. I was definitely in that boat, especially by the end, not the end, but the middle of April. My portfolio was down 15%. Not good. But guess what? It's May. I want to talk about several things, and so let me not waste you guys' time. So here's my new revamp portfolio. I currently have $60,000 of my personally owned money invested. That I've been investing for the past, let's say, 5 to 7 years. The first couple years, definitely you live and you learn. Definitely was trying to outbeat the market without investing into Apple and Microsoft. I wanted to go my own way, and I just learned that if I could go back again, one of my investment mistakes as an investor is that I would just invest into the S&P 500 and then just would have received uh, market returns instead of trying to beat the market. I just would have just got returns with the market, and I would have done well. But since I've been growing in my career, I've been growing in my different jobs. It allows for me and my portfolio to grow as well. And a couple years back, you will see that my portfolio was at like 30,000, 40,000, and I've come a long way. And I really want to hit. So it's May right now. I really want to hit this for this to hit 100,000 by the end of the year. I'm contributing roughly $2,000 into my portfolio per year, and let's see how that goes. Uh, what you see here is that my largest stock is Broadcom, Microsoft, Kroger, Meta, and SCHD. Those would be my top 5 stocks, which would helps. The SCHD portion helps because for the diversity. Kroger because of the consumer staple portion, and then the other 3 are just highly volatile tech stocks. That's in the Magnificent Seven. And the way I have constructed my portfolio, I was thinking, man, I've seen other people's portfolios, other content creators, and man, their portfolios are dope. Meaning, like they have pretty much portfolios of just constant all growth stocks, all Magnificent Seven, all just Apple, Microsoft, AMD, or even small caps. I For me, I definitely if my portfolio can make between 15 to 25% annual rate of return, I'm completely fine with that. And how I plan on doing that is what you see is that my portfolio is about roughly 45 to 50% tech from Broadcom, Microsoft, Meta. We have TSM semiconductor play. I have Tesla. I have the market, VU. Got to keep the market so you keep the portfolio stable. Uh, and then I have Amazon and Palantir down here at the bottom. What you'll see is that I have a ton of highly volatile stocks like Meta, Amazon, and Palantir. I believe Palantir is the future, and why not have some exposure into Palantir in my portfolio so that uh, it grows for the next 10 to 15 years, and hopefully my portion of Palantir grows to about 100,000, 200,000, 250,000. I'll take that. It don't have to be anything longer than that. It can be 150,000. If Palantir in the next 10 years, by the time I retire, if this bad boy grow to over six figures, 100,000 or up, 100,000, 150,000, 200,000, this would be my catalyst to pay off my remaining debt and to sell my house and then just move outside the country, and at least have that money liquid powder component on the side of my portfolios to live off of just in case the market goes down, right? Then I have other growth companies in my company. I mean, in my portfolio, like American Express. I have Meta, I have Google, and I have Amazon. Those magnificent seven stocks. Bad boys can continuously compound and get that money. And I've also, for safety in my portfolio, I added Berkshire Hathaway. I've added AbbVie healthcare. So when it's times in the market when there's a recession or when it goes down, the typical industries that does well is consumer staples, utilities, and just safe havens like waste management, Walmart, Costco. In this case, Berkshire Hathaway, because they have over like 500 billion or five over they have a big chunk of change of their money in cash. They just gain the interest, and also they can reinvest to buying new companies, buying new stocks, share buyback. So, in thinking, Berkshire Hathaway is the defense company. Berkshire Hathaway is really like a mini ETF within itself. I have American Financial Group, which is an insurance company. Insurance is going to do good in bad markets, in good markets. Same with Aflac Insurance, going to get paid off premiums, and Kroger is going to be my anchor stock in my portfolio to help just when the stock market was going down for majority of April. Kroger was the only stock that was in the green. Right here, I'm close to 75,000, and it's only May. So hopefully, with me contributing $2,000 per month, I'm able to hit it at least by the end of the year or towards the beginning of 2026. But cross fingers, hopefully 2025. Let's talk about the diversification of my portfolio. What you see here is that my technology pie is really big. I've invested almost close to $30,000 into tech by itself. Have a little healthcare here, little industrials, some consumer cyclical. We have consumer defensive with Kroger, consumer services with Google and the MetaPlay, ETFs 8,000, 8,500 split between SCHD and VU. And if you don't know, I love the financial service. I love the financial uh, industry. Make money, get money in your pocket, and that's what American Express, Aflac, Goldman Sachs, Berkshire Hathaway, and American Finance Group. Let's go over the detail, the dividends that I received for the month of April. I've only received really probably just one stock. So right here, this is about the dividends that I received in the month of May. Right here. So for the month of April of 2025, I received $9.42 from American Financial Group and $12.48 from Taiwan semiconductor, and I plan on contributing more to that. And my next investment into a dividend growth company should put me over $1,000 for the entire year. What I realized is when I was building out my portfolio, I was realizing that like, man, I was getting to the bag, getting to the money with my portfolio. Here's definitely the year on cost, and my year on cost is high with Kroger, meaning that if someone was to buy Kroger right now, their dividend yield would be 1.78. But I've been owning Kroger for about 3+ years, and that same buy, my Kroger position is producing 2.75% in regards of yield on cost. I have a 2.61 yield on cost with Aflac, and I just recently bought AFG. Have a good yield on cost position with Goldman Sachs, and then anything below that is pretty much tech companies. So you got Microsoft, you got Alphabet, which is Google, you got Comfort Systems, and these low yielding stocks are high growth companies. So Fix, which is Comfort Systems, I'm buying and I'm investing into this company because it's a high flyer. It grows. It's going to compound. We have Tesla. We have Meta, with social media. It's going to compound the growth. So that's why I really wanted to diversify my portfolio, and which is good, with a blend of dividend paying stocks, dividend growth stocks, and just total returns stocks, so that my portfolio can grow more than 15% or 15% as a minimum base of growth on an annualized basis. But also when it's times like this, when it's bad, I want my portfolio to pay me out dividends so I can live off of, not now, but in 15 to 20 years, and for it to also, the money to continue to grow, and all while not have to worry about selling half my portfolio, all of my portfolio, which if my dividends are growing, I can live off of. And all I would need is about $35,000, $40,000 in dividend income on a yearly basis to live off of. And I'm close. Where once I get the first 1,000, then we could double it. Then we could double it again, and then double it again, and we're gonna make this money. So this is how much I made in dividend income for the month of April, because we're in May now. So all in all, I made $21.90. You see that the month prior, I made close to $200 for the month of uh, March, and didn't have to do anything. So these stocks you just buy, you hold, don't have to do anything. Your passive income grow, and this how you're able to grow and have multiple streams of income. So make sure you like and subscribe to my channel. I'm back, baby. Yes. Be my peace and out.